Okay, so if you want to determine if you are truly ready to buy a home, I highly recommend that you consider this number one free tactic, and that is understanding your debt to income ratio. So that's what we're going to talk about today. If you are new here, hi, my name is Jocelyn, and I'm the founder of Real Estate Prep, which is a community for first-time home buyers that are looking for the tools, tactics, and resources they need to make one of the biggest purchases of their lives, and that is usually their first homes. So, as I mentioned, usually people are uncertain on whether or not they're ready to buy a home. And the simple way to determine that, if you plan to go the traditional route, which is using a lender, is to calculate your own debt to income ratio. You don't have to go to a lender to do that. You can absolutely do that on your own. So what is a debt to income ratio? A debt to income ratio is essentially a percentage that that you essentially assign to yourself that's based on your existing debt, your existing monthly debt. So that can be your rent, student loans, car note, like any type of fixed expense that you have. Usually it's not utilities, groceries and stuff like that, because that can be variable, meaning that it changes all the time. So you take that total amount of monthly expenses and you divide it by your total monthly gross income. So that's the money that you get before taxes. So if you're making $96,000 a year, if you divide that by 12, that's $8,000. That will be your gross income. And then again, total expenses for the month, not including the variable expenses that you have, divide that by your monthly gross income, and that gives you a number. And that number is then transferred into a percentage, and that is your debt to income ratio. It's usually in a percentage based layout, and that is something you can do online. So I will hyperlink a debt to income ratio calculator below in the description box, and what you can use to determine if you have a good debt to income ratio is to determine where you fall in these three buckets. So the first bucket is to be under 30%, 36%. That's what lenders like to see. They like to work with lenders or work with borrowers that are under 36%, because that means you have a good hold on your debt, or you have no debt, or you have low debt, and your income suffices enough for them to feel confident enough to lend you this money. If your debt to income ratio is between 36% and 49%, then okay, that means you have a little work to do, but we still feel confident that you can do the work. We still feel confident lending to you, but that might impact a few things. For me, it impacted how much I was pre-approved for the first go around. It impacted the types of loans that I had access to. It impacts so much that people don't think about, because that debt also impacts your credit score. Ultimately, if you decide not to pay, guess who they're calling? They're calling the credit bureaus and saying, hey, Jocelyn didn't pay. Do something about that. That's literally what it is. So it impacts you so much more than what people think about. So that's the 36 to 49%. I was at 48% the very first time I tried to buy a home almost a decade ago. Wasn't a good situation. All the offers I put in, basically I was ghosted by all the sellers because they felt like it was disrespectful. Even though back then homes were much cheaper, I was still living in a highly, a high income area. So there were only so many homes I can consider. And the fact that nobody responded just really, it didn't work well for me. It didn't seem right in my spirit. So thankfully I had a really good agent and a great lender at the time that told me and encouraged me to take some time away from the home buying process and get my debt together so that, I can lower my debt to income ratio. And, ultimately that will improve how much I'm approved for in the future, which is exactly what I did. I paid off all of my student loan debt, and I'm so happy that is behind me. So the last bucket is 50% or higher, and this is basically a no-no for lenders. So that means that you have a lot of debt, and you may have a lot of income, but a lot of that income could be going to debt. Even if you're paying on it or not, they still are counting it, So you could say, oh, well, I'm deferred, or I'm doing this, or I'm doing that. It doesn't matter. Lenders still want to know that it's attached to your name, and they will find that out. So that is a sign that you just may want to pause and just get your income together so that less of your income is going to your debt, which means that no surprise, you have to start paying down some debt. So I'm not saying that you have to pay it all off like I did. I just was so frustrated off that experience that I did. But what I recommend, or what I did, and I do recommend it still, is to tackle the high interest debt first. So all of the debt and all of the student loans that I had that were private had super high interest rates, which means that a lot of the money I was paying wasn't even going to the principal, it was going to the interest, which extends the life of the loan. So I started with that. I was making 2 to 3 payments a month because I wanted to touch the principal, and then I wanted to see that number go down. Now it went down slow because it's a high interest, and if you're someone who likes to see the number decrease quicker, maybe tackle some of the smaller debt first. But I try to warn people against that, because if it's a small amount of debt already, then it might not even impact your debt to income ratio the way that you think. So for me, I wanted to see that percentage go all the way down, okay? And that's what it did, but it took time, and people get frustrated. I was one of them. I absolutely understand that. But now I feel so good that I don't have to deal with it. And it just made my home buying experience so much better, because I hated being limited with the type of homes that I can consider. I hated that my interest rate was so high. I hated that I could only utilize so many loans. Like, I don't like to be restricted. You know, like, I don't want to be restricted. This is too much. This is my livelihood we're talking about. This is my home. So I just had to do what I needed to do. So again, that was my recommendation. But ultimately what I want for you is to make a plan. Use the calculator in the description box to do your, to run your own debt to income ratio. It's free. You can do this however many times as you want. It doesn't touch your credit score at all. But I do recommend that you do this and continue to monitor it and run it as you continue to pay down your debt, if that's where you're, you know, well, usually it is if you have a high debt to income ratios because of the debt that you have. So find a way to lower that. Make a plan. List all of the debt that you have, and if you want to go the route that I did, tackling the high interest debt first, do that. If you want to see some small wins, knowing that they collect up to big wins, start with the smaller ones, but do something, like take action. I was talking to someone on Instagram earlier today, one of my followers, and I consider her a friend at this point. Like, I don't consider my followers friends. Like, this is a community. Like, we all just kicking it on here and learning from each other and encouraging each other. So she's going through the same thing that I went through, you know, the first time around when I was looking to buy my house. She's very frustrated. She's paying off her debt. She paid off $15,000 last year, and it's still not giving her the return that she needs as it relates to her debt to income ratio. So she wants to give up. And I was like, no, like, do not give up, because I did it. Like, you can absolutely do it. It's going to take time. It took me almost 2 years. It took me almost 2 years. I had to readjust my whole lifestyle to make this a reality. Like, the goal does not have to be paying it all off. I did that because I was sick of it and I never wanted it to hump me again. And I knew that I was ready to be an investor. So having debt was only going to slow down that process. So you have to do what's best for you, but make a plan and do something each day that gets you closer to that. If that means eating home at more, saying no to more things, like, do what you need to do, because it's worth it. Like, it is so worth it. And I can empathize and sympathize with the feeling of feeling defeated, because I felt that way, and I don't want anyone to feel that way. But just know that it's just a little harder, and it's only going to get harder and harder. So just stick with it and continue to monitor your debt to income ratio. So that got real deep, but let me just recap. The number one free tool that you can use to help you determine whether or not you're ready to buy a home right now is your debt to income ratio. Stay below 36% if you can, because this is the number one thing that lenders use to determine your credit worthiness, which means that they're comfortable and confident enough to lend you money. If they don't feel that way, then they are going to give you a high interest rate. They're going to limit how much you're pre-approved for. Like, it's just going to be a snowball effect of so many things happening that are going to frustrate you, especially if you lived in a high income area like I did. Try to stay below 36%. That's a good thing. 36 to 49%, you're okay, but you may need to do some work depending on where you fall in that spectrum. 50% and above, take some time away from the home buying process. Get your debt together, get your income together, so that so much of your income is not going to your debt, and start tackling that debt. Take it one day at a time, make a plan, and work the plan. So thank you so much for watching. If you have any recommendations on videos that you want me to do, please comment below. Please share this with a friend, a family member, a colleague, or someone that you know that is actively looking to purchase their first home this year, next year, or whenever. And let me know how you feel about it. So I appreciate you all, and I will see you on the next video.